Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Lisa Insalaco, mortgage broker in Cambridge, North Dumfries, on.
If you're a homeowner in your late 60s or early 70s, your home might be worth $700,000, and you might be watching your savings shrink every month. So why does it feel like that equity is completely locked away from you?
That tension is exactly what Lisa Insalaco works with every day in Cambridge and the surrounding region.
And it's more common than people realize out there. Cambridge, Kitchener, Waterloo, Brantford, Guelph. Longtime homeowners who bought decades ago and built real wealth in their properties.
But the wealth is in the walls, not the bank account.
So let's talk about a specific situation that Lisa Insalaco sees regularly. A widow in her early 70s, Cambridge homeowner, owns her home outright, modest pension, savings that are drawing down faster than she's comfortable with.
She's heard about reverse mortgages, but she's assumed they're for people in financial crisis. A last resort, not a planning tool.
And that assumption is costing her. Because she's sitting on roughly $700,000 in home equity and she doesn't know what's actually available to her.
That's the problem Lisa Insalaco spends a lot of time entangling. Not the math, but the misconceptions that get in the way before the math even starts.
So let's back up. What is the standard path for a retiree who needs to access cash and has significant home equity?
The conventional answer is a HELOC, a home equity line of credit. Lower interest rate, flexible access.
Sounds reasonable. What's the catch?
You have to qualify based on income. And you have to make monthly interest payments at minimum.
Which is exactly the problem for a retiree whose income is primarily a pension.
Right. The product that's supposed to help them access their equity is designed around an income profile they no longer have.
And there's another wrinkle with HELOCs that Lisa Insalaco flags for clients. The lender can reduce or freeze the credit limit at any time. It's a demand product.
So even if a retiree qualifies, the access isn't guaranteed to stay open.
A conventional refinance has the same income qualification problem. And for a homeowner whose income is pension-based, that door often just doesn't open.
Which is precisely why the reverse mortgage exists as a distinct product. It removes income from the qualification equation entirely.
So let's get into what Lisa Insalaco actually explains to clients when they sit down with her. What is a reverse mortgage?
It's a loan secured against the equity in a homeowner's primary residence. Available to Canadians aged 55 and older. No monthly payments required during the life of the loan.
The borrower receives funds, lump sum, scheduled advances, or a combination, and the balance is repaid when the home is sold, the homeowner permanently moves out, or the estate settles the loan.
In Canada, the primary product is the CHIP reverse mortgage through Home Equity Bank, which is a federally regulated Schedule I bank. Equitable Bank also offers a reverse mortgage product.
So these are regulated lenders operating under the Bank Act. This isn't a fringe product.
Not at all. And the maximum a borrower can access is up to 55% of the home's appraised value. Though the actual amount depends on age, property type, location, and the interest rate environment.
That location piece matters specifically for the Cambridge market. Home values there are generally lower than in the GTA. So the same percentage applied to a lower appraised value produces a smaller dollar advance.
Lisa Insalaco walks clients through that math directly. A homeowner qualifying for 40% of a $700,000 Cambridge home receives $280,000. A very different number than the same percentage on a $1.2 million Toronto property.
But $280,000 to $350,000 tax-free, with no monthly payments. For a lot of retirees in this region, that changes everything.
And the tax-free piece is significant. Because a reverse mortgage is a loan and not income, the proceeds don't count as taxable income in the year they're received.
Which means no impact on OOS, no impact on GIS eligibility.
For retirees carefully managing income to preserve government benefits, that distinction is not a small thing.
Let's talk about who qualifies. Because this is where a lot of people are surprised.
All homeowners on title must be at least 55. The property must be the borrower's primary residence. And unlike a traditional mortgage, income and credit score are not the primary qualifying factors.
The lender is primarily looking at the value of the property and the age of the borrower.
And if there's an existing mortgage on the property, that doesn't automatically disqualify someone. The outstanding balance gets paid out from the reverse mortgage proceeds at closing.
Lisa Insalaco sees this scenario regularly. A homeowner in their late 60s with a small mortgage balance remaining. The reverse mortgage eliminates that payment entirely.
Immediate improvement in monthly cash flow. That's a meaningful outcome for someone on a fixed income.
Now let's address the misconceptions, because this is where Lisa Insalaco says the most important work happens in the conversation.
The biggest one, and it's persistent, is that the bank takes ownership of your home.
Which is false. The homeowner retains full title throughout the life of the reverse mortgage. The lender holds a mortgage registered against the title, the same way any mortgage lender does.
The homeowner is still responsible for property taxes, home insurance, maintaining the property. Ownership stays with the borrower.
The second misconception is that you can owe more than the home is worth.
Canadian reverse mortgage lenders include a no negative equity guarantee. As long as the homeowner meets the obligations, maintaining the home, paying property taxes and insurance, living there as their primary residence, the amount owed at repayment will never exceed the fair market value of the home at the time of sale.
The estate is not on the hook for a shortfall. That guarantee is built into the product.
The third misconception is that there will be nothing left for the heirs. And this one causes a lot of families to dismiss the conversation before it even starts.
The reality is more nuanced. Whether equity remains depends on how much was borrowed, how long the loan was outstanding, the interest rate, and what the home is worth at repayment.
In many cases, significant equity remains. The outcome depends on the specific numbers, not on a blanket assumption that home equity disappears.
And the fourth misconception, the one that Lisa Insalaco says does the most damage, is that a reverse mortgage is a last resort.
It's a financial planning tool. A well-established form of alternative mortgage financing designed for homeowners who have built significant equity and want to use it thoughtfully.
Selling, downsizing, a HELOC, personal savings, those are all options. The reverse mortgage is one option among several, and the right choice depends on the individual situation.
Lisa Insalaco's approach is to lay those options side by side so the comparison is clear. Not to push toward any particular outcome.
Let's talk about cost, because it's real and it deserves a straight answer.
A reverse mortgage costs more than a conventional mortgage. Interest rates are higher, and because no payments are required, the interest compounds over time and is added to the loan balance.
The amount owed grows each year the loan is outstanding. That's the trade-off for not having monthly payments.
There are also upfront costs, an appraisal fee, typically $300 to $600, closing and administration fees, and potential prepayment penalties if the loan is repaid early within a fixed term.
And there's one cost that Lisa Insalaco makes sure clients know about upfront: independent legal advice. The lender requires it before closing.
The borrower meets with a lawyer who is not acting for the lender, to confirm they understand the terms. It's a consumer protection measure built into the process.
Not optional, not a surprise. Lisa Insalaco explains it at the start so clients are prepared.
That's a good window into how she works. The goal is that clients arrive at closing with no lingering uncertainty.
Let's bring it back to that Cambridge homeowner we opened with. After going through the numbers with Lisa Insalaco, she learned she could access approximately $280,000 to $350,000 tax-free.
No monthly payments. She uses a portion for deferred home maintenance, sets aside a reserve for property taxes and insurance, keeps the rest accessible for living expenses and healthcare.
The loan balance will grow over time. But her home has appreciated significantly, she has no dependents relying on the equity, and her priority is living comfortably and independently in her home for as long as possible.
For her situation, it's not a last resort. It's a reasonable, well-considered choice made with accurate information.
And that's the outcome Lisa Insalaco is working toward, not a signed application, but a decision made with confidence.
The Cambridge and Kitchener-Waterloo region has a growing share of residents aged 65 and older who hold substantial home equity and limited liquid retirement savings. This conversation is relevant for a lot of people in that corridor.
Longtime residents who bought in Cambridge in the 1980s for $120,000 and are sitting on $700,000 today. That equity is real. The question is whether the discomfort about using it is based on accurate information.
That's exactly the question Lisa Insalaco helps people answer, without pressure, without rushing to a product recommendation.
If you're a homeowner in Ontario aged 55 or older and you're wondering whether a reverse mortgage makes sense for your situation, the questions worth getting clear answers to are: what's the maximum I qualify for? What's the current rate? How will the balance grow over 5, 10, or 15 years? And what are my alternatives?
A mortgage broker who specializes in reverse mortgages should be able to walk through each of those clearly. If the answers feel rushed or vague, that's worth paying attention to.
You can find Lisa Insalaco at yourmortgageshrink.com, and her full professional background is available through her Authority Hub profile.
Nearly 21 years of mortgage financing experience across Cambridge, Kitchener, Waterloo, Brantford, and Guelph, and a specialty in reverse mortgages that's built around making sure people understand the full picture before any decision is made.
The lesson here isn't that a reverse mortgage is right for everyone. It's that the decision deserves accurate information, and that too many people who could genuinely benefit from it have never had it explained to them clearly.
That's the work Lisa Insalaco does. And it matters.
Lisa Insalaco is a mortgage broker in Ontario and surrounding areas specializing in reverse mortgage.